Good morning, folks. Good morning. Good morning. My name is Peter Stanton, and I'm the publisher of the Worcester Business Journal. And it's my pleasure to welcome you to our annual Economic Forecast Breakfast, which is a partnership of the Worcester Business Journal and the Worcester Regional Chamber of Commerce. As you can see from the program, we've assembled a terrific panel, and I want to thank each one of them for taking their time out of their busy schedule to be here with us this morning. I'm sure we're all looking forward to learning about how they see the year ahead. This event is made possible by the support of our sponsors and by the hard work of the events team from the WBJ and from the Chamber. So let's thank them. And I certainly also want to thank all of our sponsors. Whoops. Sorry, I just got a text. Peter, that's the same canned, scripted, 25-second introductory speech that you've been making for years at this event. Signed, CC. Is there a CC in the room? Sorry. I think that might have been Governor Christie. But no apologies here. Just like to get through things. So on to our sponsors. I'd like to thank all of our sponsors, our presenting sponsors, which are Bank of America, Merrill Lynch, and WPI's Robert A. Foisie School of Business. Our community sponsor, Worcester Business Development Corporation. Our corporate sponsors, Kelleher & Sadowski, and the newly named Mercantile Center in downtown Worcester. Our supporting sponsors, Blais, Lynch, and Spectrum Business. And our coffee sponsor and media partner, Millbury Credit Union on the Coffee and TV Channel 3. And I just want to mention that this event is being filmed and it will run on Charter TV 3 several times over the next month. So you can look for that schedule in the if you want to recommend that someone else see this or see it again yourself, you can look for a schedule on WBJ or on the TV3 listings. So without further ado, I'm going to hand over the podium to Tim Murray, the President and CEO of the Worcester Regional Chamber of Commerce. Tim.
Thank you, Peter. Good morning, and I just want to echo Peter's comments and thanking our sponsors for helping make this event happen. This is kind of a unique event in terms of all the different things that happened during the course of the year, where we get into the substance of what's happening with our local economy and how it interfaces with the New England economy and the national and international things as well. So I look forward to the conversation and discussion and feedback from our panelists. It's all very relevant to us at the Chamber as we go about our work on behalf of our members with our recruit, retain, and incubate agenda. And let me just say, with the work of a lot of people in this room, it's been a great week, and I think it underscores that there's a growing momentum as the economy improves, albeit not as fast as any of us would like, that it's manifesting itself here in Worcester with the announcement just yesterday of Mercantile Center and soon to begin construction of $40 million, a big phase of the downtown project. Much of it made possible because of the work of one of our speakers today, Fred Eppinger in Hanover Insurance and their board. So we want to thank them, and it's great to see those hard hats and people working as the work goes forward. Also, the return of professional hockey back to the city of Worcester, a significant multi-million-dollar investment being made by Cliff Rucker, who believes in this community, in this region, not just from a hockey-based perspective, but seeing what's happening in the downtown and seeing really the great diversity of our economy. So an exciting week, and look forward to the forecast and discussion from our panelists. I want to acknowledge the staff as well of the Worcester Business Journal and the Chamber who've done a lot of work to put this event together, and thank them as well. So I'll turn it back over to Peter.
Thanks, Tim, and I know your hand and the Chamber's hand is on a lot of the development going on in the city, which is very exciting to hear about. I'd like to invite up Matthew Shiely, the first Vice President, Resident Director of Wealth Management. He's a Wealth Management Advisor of Global Wealth Management at Merrill Lynch. It's a big, long title. Matt, you're on.
Well, thank you, Peter, for that kind introduction. So let me just start by saying that Bank of America Merrill Lynch's long-standing relationship with the Worcester Business Journal and the Chamber of Commerce is very much valued. We love sponsoring events like this. This is my 5th economic forecast event, and I'm just always amazed at how many of the great community leaders and business leaders are in this room at one time. I'm really surprised that any work is actually getting done in the city of Worcester right now. So I'm hoping that many of you have seen our ad campaign. It's called We're Better When We're Connected. I've said this before. I cannot think of 2 organizations that exemplify this better than the Worcester Business Journal and the Chamber of Commerce. The Worcester Business Journal is really the definitive, this region's definitive source for business news, delivering every day the news business leaders need to know. It's my favorite source of business information when I'm in my office and trying to stay connected to our community. I also, we're also all connected here by the Chamber of Commerce. I think they do a lot of great work promoting our city and our region, and I'm really thankful for Tim Murray's efforts. So, many of you may not know this, but Charlie Merrill spent some pretty formative years, I should say year, in Worcester. He was a postgraduate student at Worcester Academy. So after that, he went on to Ameresco, and after that, he went on to found our firm. And he made some amazing contributions to our society, including bringing Wall Street down to Main Street. So Bank of America Merrill Lynch is part of the fabric of our Worcester and Central Massachusetts neighborhoods. Our goal is really to help customers and clients live better financial lives. Our charitable foundation and our local volunteer efforts are focused on workforce development and education, community development, and then basic needs for those who are less fortunate. We know we are only as connected and healthy as the communities where we do business and where our 6,000 Massachusetts employees live. I'm joined this morning by several of my Worcester-based colleagues. You may know some of them. They're sitting right here at this table. They represent Merrill Lynch, U.S. Trust, our business bank, and our consumer bank. So there they are right there. My teammates and I are pleased to have our colleague Karin Kimbrough. Karin is the head of macro and economic policy at Bank of America Merrill Lynch, and she is joining us today as one of the presenters. So if I have a big title, hers is even much bigger. So Worcester, as you may or may not know, is a critical market for us. We've aligned our world-class wealth management with our world-class banking under the leadership of our market president, Ed Shea. Ed, could you please raise your hand? Ed does not have an easy job. His job is to basically to orchestrate our firm and deliver the best we have to our clients and our customers, whether they're big institutions or individuals. So first, I'd like to thank Peter Stanton and the Business Journal for our partnership that helps us keep a finger on the pulse of the business community. I'd also like to thank Tim Murray and the Chamber of Commerce, who are looking out for all of our mutual business interests in the city and in the region. So thank you very much.
Appreciate it, Matt. And next is Joseph Sarkis, who's the department head and professor at the WPI's Robert A. Foisie School of Business. Joe.
Thank you, Peter. Thank you, Tim, for co-sponsoring this event for us. We view it as a very important event, and this is why we are sponsoring it. This is our 3rd sponsorship, I think, this past year with the Worcester Business Journal. I echo the remarks that they do have a good pulse on what's going on in the Worcester community, and we're very proud to be involved in partnering with them again this year. So let me give you a little bit about the Foisie School. And we realized that our relationship to the Worcester community, the health of the economy in the Worcester community is important to us because it also helps to improve the health of the Foisie School as well as WPI overall. The Foisie School is one of our nation's best business schools and is accredited by AACSB, one of the nation's premier business school accrediting agencies. Given the theme of this event, I'd like to point out a variety of ways that we at the Foisie Business School and WPI contribute to the Worcester economy, since this is the theme of what this conference is about. First, our educational mission and students, especially our technology-oriented graduate programs. These programs include the Innovators MBA and 4 different master's degree programs, including a master's degree in information technology, a master's degree in operations and analytics, a master's degree in management, and a master's degree in marketing and innovation. We believe that an educated workforce is probably the biggest economic development that we can contribute to the Worcester region. But we also contribute in other ways. For example, our unique community and business outreach programs for existing companies. As an example, the Foisie Business School Center for Innovative Manufacturing Solutions, wanted to get that name right, it's a relatively new center that's sponsored by Mass Development, which uses matching grants and WPI expertise to help small manufacturing companies create local jobs. Professor Wally Towner, raise your hand, Wally, is the director of the center, and he's here so you could speak to him. And again, the purpose of that is to help existing small companies promote and develop jobs using new technologies and new processes. Third is our unique entrepreneurial support through what we call the Tech Advisors Network, or TAN, our virtual incubator for entrepreneurial ideas. It nurtures and nourishes entrepreneurial ideas through advising and networking, helping to fill gaps in new venture development. As a matter of fact, we have a representative, Phil Sir, raise your hand, who's also a member of our Tech Advisors Network at WPI. Fourth, we support various economic development efforts in our community through organizations such as the Venture Forum and another entrepreneurial organization which originated at WPI. Finally, I only have 3 minutes here, very quickly. We have a new emergent educational certificate programs to help our future economy, looking to the future. These new programs include programmatic initiatives such as financial technology, or fintech, business data analytics, healthcare management programs, and sustainability. We view these as important industrial developments for our future economic well-being, and I think WPI and the Foisie School are very well positioned to help us achieve those items. These are Foisie School business initiatives within WPI. WPI as a broader community also contributes in different ways. For example, one of the new initiatives we have on campus is called the Foisie Innovation Studio, which helps students and young entrepreneurs develop ideas that hopefully can be eventually generating additional jobs for our community and region. Also, we have one of the leading university corporate engagement programs in New England. And for more information about our corporate engagement, please see our Vice President of Corporate Engagement, who happens to be with us today, Stephen Flavin. Stephen? Very good. So that's it. I just wanted to give you a scratch the surface perspective on how WPI and the Foisie School contribute to the economic development of our community. Thank you very much. I look forward to hearing our panelists and our discussants later on into the questions, and hopefully for a bright and wonderful future for the Worcester economy. Thank you.
Joe, that was perfect. I had you in 2 minutes and 58 seconds. Thank you. Anyways, and next, some comments from our community sponsor, Craig Blais, the president and CEO of the WBDC.
Thank you, Peter. I just wanted to get up and thank the Worcester Business Journal for partnering with us. As most of you probably know, the WBDC is 50 years old. We celebrated that in 2015. In partnership with the Worcester Business Journal, we produced a economic guide, which will serve as our annual report at our upcoming annual meeting in April. The Worcester Business Journal did a fantastic job partnering with us, and thanks to all of you who supported that, sponsored it, purchased ads in it, just to highlight the 50 years of the WBDC. And I just wanted to take a moment. We're usually on the front end of economic cycles. It's sort of when the economy is in the downturn and what's to be or what's to come in the Worcester region, Worcester County, the city of Worcester. The first 10 years of the WBDC was to prep the sites for our industrial parks. And they did that very successfully in the first phase of the WBDC 50 years ago. 11 industrial parks in the area, places that you would see today, the Millbrook Distributor Park and Higgins Industrial Park. We prepped all those sites during the early years to provide jobs and to expand the economy. And then we turned to the next need of the economy in the second phase of WBDC's existence, which was to look at the biotechnology industry, to get on the front end of biotechnology research. And they spent, in that phase, about 20 years partnering with the new, at that time, new University of Massachusetts Medical School and Hospital, this facility here, the Beechwood, acquiring the 75 acres of land to do 1 million square feet of biotechnology research here. Again, prepping the land and getting that ready for development and creating the jobs and the new economies for Worcester. And then the next phase was brownfields development. As you know, there was a report done in the late 90s that said we had over 200 brownfield sites in the city of Worcester, and we were losing about $1 billion in tax assessment and revenue for the city. And we had to do something about it. The legislature had passed the new Brownfields Act of 1998. And we came in and partnered with WPI and said, we're going to take on an area. And we worked for the next 10 years on Gateway Park, which now houses a lot of the programs here that will be discussed and have been discussed this morning. That was the next phase of what needed to be done to prep those sites. And we continue to do that today as a constant momentum builder for the city of Worcester. For the next 10 years, the next phase is we've really focused now on the downtown. And you heard a little bit about this this morning from Tim and the Chamber of Commerce, the work that we're all doing at the EDCC to partner to bring about some change and to prep the downtown for the next wave of momentum and investment that's to come in Worcester. And I want to echo Tim's comments, the leadership of Fred Eppinger, who you'll hear from this morning, and Opus Investment. They set the stage at City Square, a stalled City Square project, if you will. And now we see the announcement yesterday of Mercantile Center. I sat around a table in Boston a couple of weeks ago with the teams that are involved now at City Square. You will see a hotel, you will see market rate housing, you will see this wonderful transformation of the towers and the remaining mall and the retail pieces. That momentum and that investment needs to spread. It needs to spread to Main Street. It needs to spread to Shrewsbury Street. It can't just be an island at City Square, and we have to prepare those sites, prepare those buildings block by block, street by street, to get ready for the next wave of investment. And we don't want to miss that wave of investment. It's critically important for the future of the city. So tip of the hat to Opus and Hanover Insurance and Fred for the leadership that was provided to really set the stage for the next wave of development in the city. We're honored to work with the Worcester Business Journal and our partners here, and we hope that great things are to come for the city of Worcester. Thank you.
So just before I hand things over to our moderator, Peter Howe, I'm going to run through the winners of this past year's Economist of the Year competition that we have. This slip of paper is sitting in that pile on everyone's table. And this slip of paper asks you to look into your crystal ball and tell us where several key economic indicators are going to land at the end of 2016. and what I'm going to show you on some of the slides is the results, just in a quick minute, of these questions from last year. And some of the folks whose names are going to go up on these slides are in the audience. And so they should be proud. You know, once, a couple of years ago, we did this. We had about 75 people, and I made the mistake of kind of posting all the results of all these questions up on the door. There was some financial advisor who'd finished like 74th out of 75, and there was like shame on people's faces, so we decided we won't actually, you know, post it on the town hall anymore. We'll kind of just recognize the people finishing at the very top and call it a day, right? Otherwise, who wants to fill it out? So, having said that, first question was, where will the Dow finish? And that high and low, those were all the guesses. We had in the mid-20s total people guessing. The low guess was 16,235. The winner was Neil Gould of Neil Gould and Company at 17,200. Second, Blaine Marchand, Middlesex Savings Bank, and third, Bill Brassard. So, frankly, people guessed pretty much on the high side, and it was lower than they thought it would be. Next. The next question was federal unemployment rate. No one guessed below 5%. It was 5%. Barnaby Horton, Merrill Lynch, thank you, and Sam Buffum from Fidelity Bank tied at 5%. Michael Roberts was next at 5.15. Someone guessed 6.8%. Obviously, we did a lot better there. And the next is mass unemployment rate. It got to 4.7. Barnaby Horton again, 4.7% on the button. Sally Buffum, Fidelity Bank, 4.75. John Bensley, Beals and Thomas, 4.9. Most folks up in the 5s and close to 6.1. So again, not nearly as optimistic as the facts turned out to be on unemployment. Next, GDP. The high was 4.7, the low 1.8. The winners, two winners, Michael Crawford, Commerce Bank, and Neil Gould, both hit it at 2.4. Peter Dunn, John Bensley, and Doug Vigneault, all within a tenth of a point. So, and then the overall score, which is sort of the average, how did you place among everyone? Number one, John Bensley, Beals and Thomas, Economist of the Year. Let's hear it for John. John Peculius, a tie, a three-way tie. Barnaby Horton, Ed Shea, who's been in the running for, who's been on the money in the money for years, and Michael Robert, a consultant. So I know for the winners, there are some gift cards that are going to be at the front table when you walk out. Chris Posse will have those. So thank you very much for entering. And we're going to run this online so the competition gets stiffer this coming year. But Ed, we're always going to look for you among the top three. Anyways, so our moderator, Peter Howe, is the business editor and CEO corner host on New England Cable News. Peter joined NECN after 2 decades with the Boston Globe, where he covered a number of business sectors, the State House, and edited the Globe 100 for several years. You can find him reporting on NECN's Business Nightly and on Sunday evenings on This Week in Business and the CEO Corner Show, which airs at 8:30. Peter has his finger on the pulse of business in both the state and the New England region, and we're very happy to have him here as our moderator. Peter, it's all yours.
Thank you, Peter, and congratulations to all those winners. I think we have some people who probably should predict Powerball Friday night. That is very impressive. And the person who picked 16,235 on the Dow, you were just a couple weeks, unfortunately, too early on that. What a month that was. So I first of all want to say thank you so much for having me and NECN out here. Community connection is so important to the station, so important to my general manager, Mike St. Peter. Probably all of you know this. We help out with Charter Channel 3 producing Worcester News Tonight in partnership with them. That's something we've been doing for many, many years. And it's something we are super proud of. I hope there's an appreciation for what a high quality, small market local newscast that is. Substantive, local, authentic. It's a great program that we are very proud to be associated with and proud to help out with. And sort of wish we could still anchor from Newton, but unfortunately we now have Telemundo and NECN trying to be on TV at exactly the same time. Now, we obviously are gathered at a time when I think we all are on the anxious side to varying degrees about what is going on with the economy. We're 7 years, technically, almost, into a recovery. I'm wondering how much longer can that go on? We've got angst in China. We've got the price of oil all over the place. We've certainly seen, if you have a 401k or a brokerage account, it's been an exciting, maybe, start to the year. Of course, as the world's most hilarious economist once pointed out, the stock market has predicted 9 out of the last 4 recessions. So our first 2 speakers, I think, will do a wonderful job helping us figure out what is signal, what's noise, what should we be focusing on, what should we be expecting. And I would like to start with Karin Kimbrough, Managing Editor, Head of Macro and Economic Policy with Bank of America, Merrill Lynch, home to a lot of smart predictors. And we look forward, Karin, to hearing the broad overview, what we should be looking for in 2016.
Thank you for that kind introduction. Okay, so good morning, everyone. Thanks for having me here. It's really exciting. I've heard great things about this event, so I'm delighted to be here today. And what I want to do in the next, say, 15 minutes or so is really just talk about what's going on in the world, how we look at it in the office of the CIO. I do work with the Chief Investment Officer, Chris Heisey, and give you a sense of what we're looking for the rest of the year, because it's been something like Mr. Toad's wild ride so far, and I don't think any of us are enjoying it anymore. Before I start with the presentation, I really want to, let's just take a step back and think, how did we get here? Well, the truth is, we got here because of China. We got here because we got nervous. We're nervous about China. We have a lot of uncertainty. It's really related not to the fact of whether China is slowing down, but how much and how are they going to navigate it, that transition seamlessly from being largely export-oriented, investment-oriented, to a consumption-based, service-based economy, which is a good thing, by the way. We did that. We did that about 40, 50 years ago. Now we are largely a service-based economy. And it's a great thing to be because it insulates you in many ways from external shocks abroad. It makes you somewhat less reliant on your exchange rate to adjust your economy. Services are labor intensive, they create jobs. They're not all quality jobs, but they do create jobs. So the fact that we have a consumption-based, service-based economy is a good thing, and I want to come back to our economy in a second, but I just want to point out China's trying to make that transition. And so far, it's been a little bit rocky. I think we can all agree. And I think the Fed has made things a little worse. I say this, by the way, as someone who worked at the Fed for 10 years until 2015. So I love the Fed. I think they did a good job. And I'm happy to talk about where I think that's going to. But I do think that in September, when the Fed focused our attention on China and decided not to do liftoff, I don't know if you recall, there was a lot of talk about would the Fed start to lift rates in September, and they decided not to because there was so much turmoil in China. I think in the end that might have been a mistake. They focused our attention so sharply on China that now we are like a cat following a laser pointer. Every piece of data that China puts out sends us up and down. So one uncertainty we have is what's going on with China. It's nothing we can control. The second uncertainty that's driving all the volatility that we see right now is, of course, energy, something else that's largely out of our control. Right? It's down 20% in the last 12 months. It is a continuing story of oversupply, something like 1.5 to 1.8 million barrels a day of excess oil supplied over demand. So even if I tell you that demand for oil is actually increasing, almost 2%, it's the supply is increasing even faster. So that's our problem. That is unlikely to work itself out anytime soon. And our oil forecast is essentially that we do think probably we'll get back to $50 a barrel, believe it or not, sometime at the end of this year. That would be my forecast if I was putting on the sheet. But right now, the first half is going to be more of the same. We have not yet found a bottom. I think we could sit around here and bump around, partly because of the uncertainty about what's going to happen with OPEC, which has, formally, not dissolved, but informally is clearly not trying to target a price, but is trying to go for market share. And we see that with their unwillingness to coordinate on production. The third uncertainty that I think is driving how we got here is, of course, the economy, right? Are we going to face a recession? That is the number one question I get from clients and advisors that I talk to is, are we going to face a recession? I'll jump to my punchline. No, I don't think so. Our house view is that there is a risk of a recession, something like 20-25%. I actually don't think we're going to have a recession. I don't think that the stock market tells us much about macro. I think the stock market tells us about how we were positioned in the stock market, how much uncertainty we have, how much risk we want. It does not tell us about the macro fundamentals of our economic outlook. So I try to separate those two. That might be my Fed hat, which might be why I'm one of those people that thinks Janet Yellen is doing a fine job. Many of you may disagree. But I think you need to look through some of this, as unpleasant as the volatility is. And speaking of volatility, I've just mentioned 3 things we're uncertain about. So I've said, it's China, it's, the course of oil going forward, and of course our economic outlook, whether or not a global slump is going to pull the US into a slump. All that uncertainty is creating volatility, particularly in equity markets. And if you have any amount of angst and anxiety, you're going to express it in the equity market. That's the number one place where volatility and uncertainty show up. That is what's happening right now. We think it's overblown. We don't think it's based on fundamentals at all. This is not a bottoms-up analysis of companies where people make a decision, I want to sell this stock because I think the earnings just aren't there, or I think they're going to cut their dividends or what have you. I think it's really based on, I want to de-risk. Why are people de-risking so much? Well, the uncertainty, but how did they get here? They got here because they had these big positions in the equity market. And frankly, that was thanks to the Fed, who for the last 7 years or so has told you, we're going to do quantitative easing. We want you to go off and find riskier assets and invest there. And if you want to get a return, you need to go in a riskier investment, or you need to go further out the curve, longer duration. And so that's what we all did as investors, and we were rewarded for it for a while, and now that's being taken away. So I think of all of this as an unwind of the QE trade. The QE trade it was okay to go into EM, it was okay to go into high yield, it was very much encouraged to go into equities and corporate debt. Corporate debt exploded. Exploded in the sense of expanded, not exploded in the sense of blew up. And as a result, as QE is starting to, I'll call it sort of unwind or pause in the sense that the Fed is no longer expanding its balance sheet, in the sense that we're no longer the central bank is no longer telling investors we're going to remain as accommodative as we have been. Investors are looking and saying, gee, I've got an awful lot of risk. And in the past, when I held this risk, I got a good return, but my vol was low. Now I'm holding all this risk, vol's not low, and I'm not sure I feel as good about it. So I think investors are starting to de-risk. And so all of this transition in China, the uncertainty in oil, and the big shifts going on there in terms of who's going to be the marginal producer, and the uncertainty around the outlook is creating everything we're experiencing right now. And now if I were able to tell you exactly when it would end, I could do that from my beach home in the Bahamas, which I don't own. I don't know when this will end. But our best guess, is that this will go on for a little while until we find a floor where we shake out all of the folks who want to de-risk, all the institutional money that's been selling, because a lot of this has been, institutional money trying to sell. And when we get to that point, which we guess is sometime in this quarter, we should expect, a stabilization. I'm not saying a bounce back. We'd love to see that, but we should expect a stabilization. And from there, I think the markets will refocus themselves a little bit on, actually, what do I want to own in my equity portfolio? What do I want to own in my bond portfolio that meets my goals or my needs? And that's how we like to think about it at Bank of America Merrill Lynch, in terms of, investing to meet your longer-term goals. So let me just mention China for another minute, and then I'll go through a little bit of the presentation, and then I'll finally close up with how we see things and maybe touch on the regional economy too. So what China's doing is pretty cool, I think. It's doing what we did. It's this big transition. They are ultimately wanting to be where we are. They want to be a global reserve currency, which they're starting to work through by joining the IMF's SDR. It's this basket of currencies that lets you pretty much be a global player. They want to have a deep and liquid bond market, which they do not have. They do not have. But they would like to have it. And what they'd like to do is they would like to issue debt in their own currency, because that's the best way to issue debt, of course. Right? That's what we do. they're working on it. They started to issue yuan-denominated debt in London last fall. And they're going to continue to try to open up their bond markets and make them deep, try to get global investors invested in yuan sovereign debt. And that's not a bad thing. We shouldn't fear, but it's a point that they're trying to make this very broad transition to becoming a global player. And in the meantime, they're facing a lot of constraints because essentially their market is still too controlled. They're trying to control their exchange rate. They're trying to, control their monetary policy. They're trying to control their capital flows. You can't do all three of those at once. So as China tries to navigate opening up their economy and achieving a slower growth path that is more consumption-oriented and less export-oriented, they're sometimes getting in their own way. And one example of that was at the beginning of the year when they decided to devalue their currency. They did this, by the way, just before the beginning of the year, very, very late in December while we were all away digesting Christmas and New Year's and all that. And we came back on January 4th, I don't know if you remember, and it was just a mess. The first day was and it hasn't stopped, essentially. What caused that was the devaluation in the yuan. That is what caused it, right? They devalued the yuan more than they normally had in the past, and the markets got spooked and said, why are they weakening their currency so much? There must be some bad news that we cannot identify. And so now a lot of traders spend a lot of time watching that yuan setting every day to see how much did China change their exchange rate. Because we don't have any other news. There's no transparency about China's policy or their intent. So we're forced to watch this data release like a cat pointer, like a laser pointer and a cat. So what you have here is essentially we're kind of captured a little bit by the Chinese data. This past weekend, we all wanted to see what the capital outflows were because that will tell us if China's really in a worse position. I know they're bleeding foreign exchange reserves, but are they bleeding too quickly? All these sort of questions are concerning us because ultimately we feel that China's so big, it is the second largest economy on the globe, that it could bring us down. And I actually disagree. I don't think it can. China is the biggest economy, second biggest economy. It's about $11 trillion. In GDP. It is, ours is around 19, by the way, trillion. But their ties to us are not very explicit. The trade ties are not huge. The financial linkages, meaning through banks and counterparties and credits and ties to our balance sheet, our financial institutions' balance sheets to their financial institutions' balance sheets, they're not there. They're not significant. Our investors, obviously, because of capital controls, don't have a huge footprint in their bond markets or their equity markets. So what I would call the channels of contagion from China to the US are relatively narrow, except for the confidence channel, which is enormous, which is why you wake up every morning, you turn on the TV or you read the news, and you find out what happened in Asia and how it traded. That's not going to go away. That's part of the global capital markets. But that's all right. So that's China. That's an uncertainty that will live with us. Right now, China is a little quiescent. We think going forward, they will wake up again. They will devalue further. There's more to come. But right now, they're in their Lunar New Year. They're about to host the G20 at the end of this month, which means they're going to have all the top central bankers and Ministry of Finance leaders convening. China is the host. The last thing they're going to do is destabilize the markets with everybody in the room who they need to explain that to. So I think they're going to... I think we're taking a pause for February. That doesn't mean the markets will pause, but I think China is, for a moment, taking a nap. But they'll be back. They will devalue further. That uncertainty has to play itself out. I don't think anyone knows. We think they are slowing to maybe something under 6%, but it's not 2%. And that's something we just have to live with, a greater uncertainty. But I don't think that their ties to the rest of the world are big enough to bring the U.S. down. The U.S. is just too solid. So let me turn quickly to the U.S. Three questions I often think about is where's the economy going from here? I'm telling you, we're not in a recession. I don't think we're going into one right now. What's going on with labor force and demographic trends? Because those are bigger structural issues that drive our ability to actually grow in the long run. I think that's a question we need to think about. And then what's the Fed going to do, which I just like to think about because I came from the Fed. All right, so my thesis is we're still growing. And I feel like people get a little bit too bearish. I just want to put the chart up there. You don't have to look at the numbers. But those blue bars are our annual growth rates from 2005 And the last two bars out are 2016 forecast and 2017 forecast. We're still growing. It's around 2%. Right? We have not fallen off a cliff. We are not entering a recession. We're still growing. It's not very high. It used to be much higher pre-crisis, but we are growing. And by the way, we're growing a lot faster than most other advanced economies. In Europe and Japan, it's something like 1% and change that they're growing. So we're doing pretty well. This is partly why you see our interest rates somewhat low, is because we are attracting a lot of global capital because we're sort of the best game in town right now. So why, I've told you that we're growing. I told you that I think we're going to continue to grow around 2%. Why am I so confident that this will hold in? Well, it's the consumer. We're an economy that's based 60% on consumers. The consumer has delevered. These are lines that explain their debt service ratio, their financial obligations. So consumers essentially have less of their disposable income consumed by credit card debt, consumed by other obligations like mortgages that they have to pay. So they've got a little more disposable income. And as a result, we say, well, what are they doing with that money? Are they spending it? Well, they are spending. Real spending has been pretty healthy, around 3%. Doesn't feel like that sometimes, but it has actually been a very healthy clip of spending. It's just changing. Spending is morphing away from brick and mortar stores to online. And it's also morphing away from goods to services. So millennials don't buy as many shirts and T-shirts and things at the mall like I did at the Chestnut Hill Mall in the 80s. They're more likely to buy experiences or technology, things they can share with their friends. So our spending is morphing, but it's still there and it's fairly robust. That said, consumers haven't spent everything they got. They got a windfall, something like $1,000 a year on average. I'll say households on average got $1,000 a year from energy price declines. They haven't spent all of it. They've spent some of it in restaurants, but they've saved it. Savings rates have gone up. So whereas in the past, the U.S. household on average was saving maybe 1, 2, 3%, it's now saving closer to 6%. Right, that's a big increase for the American household. So we're saving more because I think we feel, looking back at the crisis, we need more precautionary buffers after the last crisis. People are still very cautious. The housing market's picking up. It's not picking up amazingly, but it's picking up. Housing prices are rising around 6%. We are seeing increased household formation by millennials who have delayed the start of, the old cliche is they're living in their parents' basement, and now they're starting to move out and get an apartment with a friend. They've gotten a job. So we're starting to see that household formation really take off, and we expect that to continue. So the housing market is important because this is the consumer's main source of wealth. As long as housing prices are picking up, consumers should feel better overall. One thing to note is here in New England, I had a look at housing prices. They've actually softened a bit relative to the rest of the the rest of the nation. So there is a sense that in to some degree, housing is sort of kind of starting to slow down here. I live in New York where it's still on fire, so I'll leave it to my panelists to explain more to me about the housing market. But that's something I noticed was that largely the New England region and Massachusetts in general seemed like it was on par with national numbers for many things like inflation. I looked at the CPI. I looked at the growth numbers for the last quarter. They seemed like they were kind of on par with the rest of the nation. But what looked different were housing prices looked a little softer and wages looked higher. And I'm sure it's a very tight market given all the biotech, all the academic focus here and technology. So it's probably not surprising, but very interesting. So you have a slightly higher wage than the national average here. It's growing more quickly, I should say. And your housing prices are softening. They're growing less quickly than the rest of the nation. So I told you, so let me finish up by just saying I think the consumer's okay. Firms less so. Big elephant in the room I haven't touched is that we're in a manufacturing recession. And the reason I haven't touched it yet is because I want to let you know manufacturing is important, but it's not as important as it used to be. So manufacturing used to be something like 30% of our output. It is now closer to 12% of our national output. So the chart on your left just shows you consumer spending generally and a savings rate in a blue line. The chart on your right shows you that companies have been ramping down their capital expenditures and plans for capital expenditures. So companies prefer to sit on cash. It may again be a precautionary matter. And I look to my colleagues here on the panel to talk more about that. But we're definitely seeing that the CapEx part has not come in. There is a global manufacturing recession. It's not just here, it's globally. That we have definitely caught that contagion from the rest of the world. I don't think that it's going to pull down our entire economy, but it definitely is weighing on firm behavior here. So manufacturing is in a recession. Industrial production is slumping here. It's been slumping since the middle of last year. It's going to bottom at some point, right? It will. But the problem is that it's completely overtaken by the decline in energy, the decline in mining and manufacturing, and the fact that we essentially can't escape just the commodity, the super cycle trend downwards in cheaper commodities. So an industrial sector recession, I've mentioned this a little bit. Manufacturing is weak. You can see this in the left-hand chart. The shaded bars are recession bars. What I want to point out is manufacturing can go down many times without it actually being a recession. So back to the old adage of like stock markets predicted 9 of the last 4 or 5 recessions. Declines in manufacturing on the left can also sometimes presage a recession, but sometimes not. And what I would just remind you is as manufacturing becomes a smaller and smaller share of our US economy's output, it should be less and less of a predictor. So using a model based on a lot of data might overweight the signal coming from a weak manufacturing sector. On the right-hand side is the point I mentioned. The industrial sector's share of the economy is shrinking, going back from 1947 to now. All right, so let me talk quickly on the jobs market. This is the cumulative number of jobs added since 1992 in thousands. Basically, the story is the light blue line is services. You have 30 million jobs in services added. The darker blue line that's under the zero axis, that's manufacturing. So on net, we're not adding manufacturing jobs. That's just where we are. The dollar isn't helping, of course, but we've been doing this for a long time. This is part of our transition to a consumption-based, service-based economy. I don't think this is going to reverse itself, frankly. I'm sure there'll be pockets of manufacturing innovation, but manufacturing is an emerging markets game now. Lastly, on the labor force, because I think it's interesting. The reason I like to look at the labor force is because when you want to talk about what's your capacity to grow, your potential growth, what can we actually hope for going out long term, you need either to have a growing labor force or you need to have some kind of productivity. Our productivity is very low and probably going to stay low for a while. There are questions about whether or not we can measure it correctly, but it's low. So the only other hope is that we have labor force growth. Well, labor force growth comes from populations joining the labor force, people who were maybe underemployed becoming fully employed, or if our population is growing, more and more people are joining the labor force like a baby boom. And we don't have that right now. So on the left-hand side, you see a blue line that's kind of tilting down. That is our labor force participation rate from, say, the mid-'80s until now. And it went up, until 1999 because baby boomers continued to join the jobs market. Women also on net were just this huge one-off hit where they suddenly left the homes and joined workplaces. And that just caused labor force participation to peak. Since then, it's been declining. A lot of people kind of bemoan this. If you go back even further, back to the 40s, labor force participation rate was around in the 60s. So we're not, which is where it is now. So we're not out of a long-term historical trend, that unusual, but we're off our peak and we're sort of looking in the rearview mirror, feeling a little anxious about it. But that's just the baby boomers. They came in, we had a great run of productivity and consumption, and now they're aging out of the labor force, and that's just where we are. We're an aging population. We're still growing, but we're aging. We're not aging as quickly or as much as Europe, Japan, and China, which is why they have bigger problems about creating growth than we will. They also are less resistant to immigration than we are, so that will also slow their potential growth. but we are facing an aging population. Even with the millennials coming on board and becoming a large second segment of our population, we're still aging. The chart on the right is just for fun. The chart on the right shows these different lines, and all I want to show is basically this is a labor force participation over time. And let me give you a good example. So the top line is a little purple line. I don't know if you can see it from the back. And it's kind of tilted down just a little bit. And so it's showing that from like 92 until 2022, this is projecting outward, labor force participation for those who are 25 to 54 years old is going to go down. So a smaller proportion of that cohort is going to be in the labor force, slightly smaller. Still pretty high, something like over 80% will be working. Now look at that orange line towards the bottom. That's the cohort of people who are 65 to 74 years old. That tells you that all the folks between 65 and 74 years old are gonna keep working. They're like more and more of them are gonna stay in the labor market. They may retire from their official job, but they're gonna keep working. So anybody who's in this cohort can give them a hearty pat on the back. They're the ones holding us up right now for growth. And the lines it's really declining. Before you get on a whole trip about millennials, there's a green line heading down towards the top two. It's kind of got a sharp decline. That's the 20 to 24-year-old set. Don't give them too hard of a time. A lot of them are actually going to school. So let me wrap up real quick and just say, I didn't get a chance to talk too much about inflation and the Fed, but let me quickly just say we're looking for the Fed to raise rates a little bit more. We don't see a recession. The markets have priced in no hikes. We're looking for maybe 1 or 2 hikes more this year, maybe 3 if things go really well. But we think the market is too bearish and is very likely to price back in a few hikes when the market calms down. Last and not least, this sector is, this economy is often, I think, associated with biotech technology. And I just wanted to say, from our perspective, biotech has had a really tough run. Our biotech analyst at Bank of America Merrill Lynch called it bio-wreck. And I think part of that is just because it's been a really tough run. It was a populated trade in the equity market, but we do expect structurally things like technology, healthcare, consumer goods to be supported by the fact that we have a strong consumer and there's so much innovation going on in technology, healthcare, and data. So I've talked a little longer than I should have. Thank you so much.
Help yourself to water. Karin, thank you. That was terrific. I feel so much better informed about everything in the economy than I did 25 minutes ago. Peter Stanton has asked me to remind you, you'll see in the middle of your table index cards like this for questions, which we would love to have you put down. They will be collected as everybody's speaking, and we'll get to as many as we can, depending on how well we do staying on schedule. Before I introduce Fred Eppinger, a man who needs absolutely no introduction to a Worcester business audience. Just one point I'd love to follow up with Karin on. You hear something, a headline, like Merrill Lynch has raised its estimate of the risk of recession from 15% to 25%. Can you say a little more about what that means? How can we be smart consumers of a piece of information like that?
What that really means is there's a greater tail risk that something wrong could pull us down into negative growth for several consecutive quarters. They base those models on a lot of information like what's the yield curve doing, how deep has the equity market decline been, and what it's saying is we haven't seen enough, believe it or not, we haven't seen enough of an equity market decline, we haven't seen enough of a yield curve inversion to actually fully price in the likelihood of a recession. We're just starting to see nascent signs that we could be moving that way. And what I would say about a recession, when people ask, are we having one? I will say, eventually, yes, but probably not this year. Probably, and here I am sort of talking off my elbows, probably 2017 and beyond, but not this year. I think people have just gotten too far ahead of themselves.
Excellent. Thank you. That's a great clarification. Fred Eppinger will add his own thoughts on the economic situation, what to expect, some great insights from Worcester, Massachusetts, U.S., and the world. Fred.
Well, it's spooky to follow a real economist. So now I get to hear from an insurance guy. Isn't that cool? What's interesting about being in the insurance world, by the way, is you get to see a lot of businesses. And so I want to make some random observations about the economy generally, but also about here and why I'm pretty bullish, as most people know, about the future of central mass and central mass business and economy. But let me just do a little bit of introduction for the folks that, I think a lot of people think they know who we are, but I want to do a little about us and what we do, because it is kind of a little bit different than people think what we do. And then I want to touch on 2 or 3 things about this economy. We went through the worst recession in all of our lifetimes, something incredibly profound. In our business, it created 4 years of shrinkage. Even in the Great Depression, we didn't have that. We had 2 years of shrinkage in our business. It was fundamentally different than anything any of us have experienced. And coming out of it, some things are really different from our perspective. And we look at the world a little weird because we see people investing, we see people taking risk, we see people changing the way they do business. And so that's our lens of the economy, but it is very, very different. And I would argue that out of all of that, it is a little bit harder to grow. It's a little bit harder as a business to compete. It is a little bit harder to be lazy or slippery or kind of not clear on what you're trying to do because there's less growth. And even when there is more demand, it's demand from people that are more particular. And so there's some real interesting changes that I want to touch on and then come back to us here in Massachusetts. So for those of you that don't know who we are, we're the 40th oldest company on the New York Stock Exchange. We're 163 years old as a company. But we are pretty entrepreneurial. We're a $5.5 billion company. And what's interesting about our company right now, we have momentum. And we've been voted best place to work by 2 of the major magazines. And we're very proud that we were the only insurance company of any significance named as one of the 50 most trusted financial services companies in the United States this year. And so we're an interesting company. We're smallish in some ways, but we have breadth as an institution. And if you look at where we are, we're about $4 billion domestically with about 4,500 employees right now. And we're about $1.3 billion internationally with about 400 folks overseas. But what's interesting about what we do is we do a lot of global things. So we're big in Africa, we're big in the North Sea and in energy. And so we see a lot of interesting things that are kind of at the cutting edge, like energy development in the United States. And so we have an interesting breadth. And in New England, we have about $500 million worth of business, and we have some incredibly deep pockets, like we're the #1 commercial insurer in Maine. So I can tell you a lot about lobster boats if you ever care to know. But we have some interesting insights about here and some other dynamics because of what we see. You can imagine we see payroll because of workers' comp. We see where people invest. We see people building. We can see exposure growth. And so it's kind of a little bit of an insight into what's really happening in some of the micro levels in our economy. As a company, as I say, I just to touch on it, we are very, very fortunate. We are one of the handful of most fastest growing companies, and we grew a lot during the downturn, which was kind of counter-cyclical. And we've been able to grow earnings tremendously. We're fortunate enough this year we made more money this year than any time in the history of the company, and I think we'll do better next year. So we're fortunate right now that we have momentum because of what we do. And it gives us, again, this broadening perspective of some of the businesses out there. So let me just go back to this. Karin was so much more insightful than I'll be about the economy, but what's interesting to us, right, is there was no question there was a recovery. But if you talk to each other, it doesn't feel as robust as any other recovery we've ever gone through. And I would argue right now, while we're positive, it's tepid. It feels tepid in most of the markets, at least we deal in. And particularly with what we call exposure growth, which is a combination of values of people that they insure in their businesses or their homes, and workers, right? And what's interesting about workers is the dynamic of workers has changed. The move from manufacturing to services has a lot of impact, both on salaries and, frankly, for us, what you insure. But it's also this part-time thing that I'm going to touch on, which is really a dynamic that is changing the workforce at all ages. And it's part of the reason why our view that the age population will continue to work. And so there's a lot happening, but again, it's tepid. And Massachusetts in here is kind of, we believe, it's got some great areas, but we're kind of the same. There's nothing distinctive. The employment is better, much better. The underemployment is, getting in a range, what I think economists would call normal, but it's still a tad high. And we do combine that with this participation in the workforce. Again, it is part of the age, but did some people at certain age cohorts get driven out of the work environment? Are they getting out of looking a little quicker? We believe that's true, just by looking at what you're seeing in the workforce. This is coming back a little bit in some pockets we see. There's some stats we'll talk about discouraged, people that are discouraged in their work, and that's getting better. Salaries, wages get a little bit better. Hours worked has got back to where it was. So that we look at stuff and it says, it's not bad. But it's not robust. But it's kind of, for us, it gives us some sense that, again, I very much believe what Karin is saying, that we won't back into a recession, even though there's a lot of fear because of the volatility in the market. And we're starting to see small commercial business invest a little bit. And so that's a tremendously good sign. So again, we have a weird lens, I get it, but it's a relatively broad lens. Let me just touch on a couple of things. Construction in various forms is a big deal to our industry. It's a big deal for the economy as well. And what you saw, obviously, is the new housing starts went to hell, and all construction went to hell. And the first thing that came back is, apartments, et cetera. But even with the comeback, we're still about 1 million jobs short of where we were. And there's a type of job that's a type of job that's very helpful, we believe, for a lot of economies, a lot of regions. And so while it's coming back a little bit and the new housing starts, it's an important thing. And watching that. So that's, when we get optimistic, it's when this keeps creeping up. Because if the housing went up a little bit, I think we'd start seeing a little bit more growth generally. And what Karin mentioned about household formations, the first time I'd heard it said that way, I think that's very helpful. And so to us, we watch this, and again, because construction is a big part of, touches so many different things in the business community. The other thing I want to just touch on is a wonderful thing about the U.S. economy and innovation. What has happened with shale and fracking and everything is unbelievable. Really couldn't have happened in any other country in the world, I don't think. And to me, it's a big deal. And so while the oil prices is scary right now, this is fantastic, in my view, for the U.S. economy to have more cost-effective energy. I would argue it'll help manufacturing in some pockets. Our business exploded around this development. So yes, it's now scary because of the excess capacity and the pricing, and so you saw that spike in jobs, and this is just exploration and extraction, but the jobs connected to energies exploded in so many pockets and in so many related businesses, and it was a powerful thing, and I think it will be for a long time. I think there'll be a rebalancing. The scary part about this, though, in the short term, and again, for a risk taker, it's a very scary thing because up until probably 4 or 5 weeks ago, people were holding on. A lot of the folks that were at the kind of marginal cost of production were keeping producing. And what we've seen is a lot of equipment come offline. They finally, part of it was probably what they had with debt or what they had with kind of guarantees of pricing that they bought contracts or whatever forwards. But we've seen that just shrink. And so, again, we're just now seeing the implications, I think, fully of what this will do for some of these economies, like a Dakotas or Pennsylvania or some of these places that really took off because of this. But again, for the long term, this is a great thing. I mean, in my view, this energy thing is a tremendous help to this country. And there's a lot of manufacturing and there's a lot of political unrest in a lot of countries where we've exported jobs that people like me are importing jobs back because we're not comfortable with that. And when the cost gets a little bit more in line, it's a good thing. And so things that are energy heavy cost, this should be helpful in some of the manufacturing pockets. So again, it's one of those things that it's scary right now. And I'm not smart enough, I'm not a good enough economist to understand why oil pricing going down is so bad, because ultimately, I know it's bad for certain countries, but ultimately it's going to be helpful in so many pockets. The other thing I just want to touch on is this on-demand economy. And it is fascinating. And you know, in our world, because we insure fleets of cars, and now you got to worry, is somebody a commercial driver or a private driver, and when does it happen? And so our little world, you kind of worry about that risk change. But this notion of on-demand workers is booming. And the question is, what does that mean? It means more independent contractor types, are these really entrepreneurs now? And what does it mean for what earning potential there is for a whole category of people? But it is one of those things that is not going away. And what we see is a growth when you look at employment in some of these categories. Again, if I'm not smart enough to fully see it, but there is an age category, if you see that are participating in this, that are people that are in their second career, and that could be a good thing. So for me, this is a very interesting trend that I don't know how many businesses people are talking about it, and so many interesting businesses, I don't know if it'll go there, but it is something that we see just many, many, many pockets. And by the way, the amount of venture money against companies trying to do this is outrageous. And so even if a lot of them fail, a lot of them will develop. The other thing I want to just leave you with the economy, and again, you think about the world, and the reality is it's a little bit two stories, right? And Karin mentioned it's the U.S. and everywhere else. And that's really what's so tricky here because of what's happening in Europe, and we had a pretty big scare this week, or at least it looks like there's some scares in the financial companies. It's great to be a CEO of a financial services company right now, by the way. And I learned from Karin why my stock goes up and down, and I have no goddamn clue. So thank you for that. Doesn't help me sleep any better, but what you're still seeing some scares because a lot of people believe that the banks in Europe did not do the good work that they did here in the United States. So there's a lot of parts around the world that are not as sanguine about whether there's a recession or where they are. And so the question for us, many of the uncertainties is, does Europe come back a little bit better? She mentioned China beautifully, so I won't. But for me, one of the most interesting things is the wage growth and the consumer spending. Clearly, it's helped trucks since SUVs, right? We've all seen that shift. It's been dramatic. The question is, where else will it show up? I hope new housing starts, because I think part of that would be quite helpful. But again, if that continued to build, that would be really helpful. And I do think, to me, that pushes off any kind of worry about a recession. And it is about fear and investment of individuals, and we'll see how that plays out. But I don't want to be too bleak about it because I think we're solid. We're tepid, but we're solid. And there's some things that if they stabilized, I think we'd be helpful. So let me just talk about Massachusetts briefly, and then I'll finish up. Obviously, many in this room were biased. Massachusetts is a kind of interesting place, right? And this GE thing, 10 years ago, would you ever have dreamed that any big corporation would move to Massachusetts, right? No way. Taxachusetts, baby. We were never the place that, and so it's fascinating. And I would argue It's because of the strength that we have, both the mix of the industry, but the workforce, the educated workforce, the talent that has been attracted to our geography is intense. It is a really interesting thing. And when there's so much innovation in our economy, Massachusetts has a very interesting advantage. The problem with it is very simple. We are incredibly high cost. Between the housing and the healthcare we're out of whack. And both of those, in most or many industries, particularly service industries, are hard to overcome. So the entire solution for this, the governor, I will probably call him and tell him this because this will solve all our problems, is Worcester. You've got to get them out of Cambridge, The nice thing, I always say the nice thing about Boston, it's on an ocean, so you can't grow east. The reality is we have what people want. We have some urban settings that are lower cost, that are high quality of life, good public education, and convenient. The distances are short. I always say that Worcester would be, if we were in Houston, Worcester would be called Boston, right? We are part of Boston. And as the transportation gets better, our opportunities get better. So I look at this and I say, the Northeast is tough, but Massachusetts has some real attractiveness. And again, some of the biggest hurdles for our economy is better in the breadth of Massachusetts versus just the east coast of Massachusetts. And so we have some advantages. And then let me just close as a insurance guy and a business person. The big economy to me is hard to think about. So to me, I think about businesses every day. Why would a business be successful? Why would it not be successful? And what does all this mean for the engine of our economy, which is the small business owner, and particularly the small business owner that's involved with services and employees, et cetera. And there's some observations I would make that are coming true, I think. By the way, my wife always says half of what I say is good. You just got to guess which half. So please, if you agree with one half, that's good, right? So there are a couple observations I would make. I don't see an economy for a long time, frankly, that rises all the boats, where the wind's fully at our back and it's easy. It's even harder to find geographies. There was a lot of times in the last 20 years where there was the places in the South or whatever. It's tricky right now. It's hard to see that. And I would also say capital, while incredibly available, looking for returns, it has really uneven access. I think through overregulation and a lot of stupid things we're doing for optics, how we get capital to opportunities is not as smart as it was. And this rebalancing of the tech world in this week, where it says they're looking for people that actually make money, it is an interesting indication that maybe that'll get a little bit better. But there is this access of capital thing that is tricky right now that is not going to stop, I don't think. I think you're going to have to there'll be some places where there'll be excess, but a good idea is a little bit harder to sell right now. I would tell you on the consumers and tech, I'll put a little bit of that together. The potential for consumers is absolutely there. But we've seen in almost all our businesses is they're more demanding. So what they require to be loyal or to buy, they have more choices. And they have more choices that they can see more clearly. And so that demanding part is really interesting. Some people call it transparency, right? Is real. And that the tech operating, the tech revolution in so many of our businesses, from newspapers to, just name it, driverless cars. I could go through almost all our industries, how there's a change. So you'll be successful, you can be successful, but you can't be standing still. So there's a change element in most businesses now that's a little bit greater. So I kind of come back to 4 basics, which is the folks that are going to win are going to be a lot clearer about why they're going to win. They're going to be a lot clearer about how they attract talent, which again I think makes our geography a little bit more interesting. There's going to be a lot more, I think, clarity about cost and delivery and margin because there's less degrees of freedom to miss. And this is a throwaway, but you can see it, which is consistent execution, particularly because we're such a service industry, is really the key to success. And that consistency of service is going to differentiate the great institutions from the poor institutions. And I live in an old industry, right? But most industries have some form of consolidation because of that. And the have and have-nots are separating, and so execution is becoming more important. So again, if you leave with anything, Worcester is the answer. I can't change that. It just keeps coming back. And again, I think being from our community, I want to echo something that some people said earlier. Momentum is a wonderful thing in business, and when you have it, you want to keep it. And if you lose it, it's a bear. And Worcester kind of has it. And the question is, how do we nurture it, and how do we build it with the opportunities that come from being close to Boston? Okay? Thank you very, very much.
That's excellent. I think Fred just wrote the new tagline for Tim and the Chamber. Worcester is the solution, what's your problem? And tepid but solid, I'm going to use that. That's, I think, an excellent description of where we are. I want to say I'm thrilled that Peter and Tim asked Peter Seigel from Stop & Shop to be one of our speakers this morning. If you think about it, what an incredibly intimate, important commercial relationship we all have with our favorite supermarket or supermarkets. You know, we've all got to eat. Those of us with teenage sons at home really appreciate the reality of that. And think about also the importance of supermarkets as employers, as drivers of value in real estate, foot traffic to other businesses, the importance of where they are and what they do for their neighbors in so many different ways. And Peter Seigel is in charge of marketing and merchandising for more than 200 stores in southern New England. And we'd love to bring you up and hear your insights into where everything is going and what you're seeing from the checkout line.
Thank you, sir. Peter is my dad, though. He's a great guy, though. So
David Seigel, I'm sorry.
that's fine. That's fine. Fred, I'm not sure where to go after that. I feel I want to take a step back and talk a little bit lighter about a serious subject. Right now, I heard words like concern, downward turn, recession. I came in here very positive today. Right now, I got to regroup because I'm not so sure. Let me talk a little bit about an industry and a business that I think affects all of your lives, whether or not you shop in my stores or in one of my competitors. But food is important to everybody. It's a big business. It's $600 billion in the United States. I joined Stop & Shop in 2012. I had the pleasure to join it, the #1 retailer for food in the Northeast. In 2014, we celebrated 100 years in business. As you folks know, it's hard to keep 100 years in business in any industry. Stop & Shop began in Somerville, Massachusetts, not that far from here, and it's grown and thrived from there. It's not the same business it was 100 years ago, though. It's actually part of the Royal Ahold Global Corporation. So in the United States, we're one of 4 divisions. Stop & Shop New England is the biggest of those 4 divisions. We have 212 stores, as Peter has mentioned, within the division in the Northeast. We also have around 200 stores in the Metro New York area, and we have stores that are out and around Giant Carlisle and Landover. In Massachusetts, we have 131 facilities. 10 of those facilities are in the greater Worcester area. We employ over 36,000 people in New England, and we employ over 21,000 in Massachusetts and over 2,000 in the greater Worcester marketplace. Worcester Business Journal ranked us number 13 as far as employees in the greater Worcester area. Stop and Shop is working from a position of strength. We're the #1 market share leader in the majority of markets that we're in. We have over a 36% share as defined by Nielsen. We're very proud of that. During the past 100 years, our values have remained fairly constant, putting the customer first, doing what's right, and getting better every day. We're striving to maintain and grow by being aware of what's important to customers and tastes, and then changing our business in order to define that. We're improving our value proposition by investing heavily back into price, which is something that is important to us, and we know that we have an opportunity with. Let's talk a little bit about the customer and what's important to shoppers today. Trends are changing all the time. When you talk to a customer today, which we do all the time, it's important for us to understand what's important. You folks are all, at one point in your time, have shopped if you don't do it on a daily or weekly basis. They're telling us things are changing, right? What's important now is to make sure that the families are well fed, that where they shop is a good value, that there are trends going on in the industry that are important to them to make sure that we accomplish what and give them what they need. Natural foods. Natural foods have grown double digits over the last several years and continue to do so. In the supermarket class of trade, that's a big growth engine for us. Some of you folks may have read Whole Foods, which obviously at one point and still is one of the biggest natural foods providers in the country, actually had some poor performance. And that's really driven by other classes of trade, including mine, being able to grow that business and do it in a solid way, giving the customer what they want, one-stop shopping at a better value. Talked a little bit about the economy, and I know one of the questions for me earlier today was, as far as the economy is concerned in your business, what's going on? We've had a lot of change over the last several years. The food industry is fairly insulated, though, from an economic standpoint. People always need to eat, which is a wonderful thing. But people's shopping habits change. When the recession first hit in 2006, 2007, what happened was people made a lot of switching for purchases. Some of them switched out of the supermarket class of trade and moved into value. Other folks looked for better solutions inside my class of trade. We worked hard to give them better solutions. Own brand or private label, as some folks know, has grown for us double digits over the last 10 years, primarily driven by better quality, the right price points, and folks actually trying it and understanding that it was as good as national brands. We have several different own brand lines. We have Stop and Shop. We have Nature's Promise, which is a natural and organic line that we see tremendous growth with and continue to see that. And I think if you folks haven't tried it yet, I encourage you to do so. And also we have a GV line, which is a value line and opening price point to make sure that we're hitting all segments of the population. What's hot in the industry? So produce is on fire. So we have seen significant growth in produce. It's one of the reasons why, from a capital expenditure standpoint, we're investing heavily in our produce departments. Instead of investing in individual remodels and stores as traditionally been done, though we do have some one-offs on that where it's necessary, we're investing in the department. So we did a lot of work to understand what consumers really want, how they want to shop, what they want to buy, the flow that they're looking for in order to be the best shopping experience. We did some testing, and right now we're rolling out right across our division in 212 stores by the end of the year, new produce departments so that we can give the customer what they want. Also in bakery, we're doing a similar thing where we've really tried to understand what a customer wants. We're going to do this right across the portfolio in order to make sure that what we give the customer is really a great shopping experience. Also, what's hot, fresh seafood. We're putting more and more service seafood cases in our stores because the customer is telling us that's what they want. Organic, I mentioned ethnic foods. Specialty foods also have been very hot. Prepare foods continues to be important to customers, especially when they're time-starved. We're making efforts in order to improve our prepared food program. We do have some work to do in order to get into the best of class, like a Wegmans, which isn't too far down the road here. But we're making some great strides, and it's something that's important to us, and continue to look for some improvements in that going forward. And local. Local is critical, I think, to our success moving forward. More and more folks are interested in being able to purchase items that are manufactured and or produced locally. We have some great relationships with local farmers for produce. We have some great relationships with some seafood providers out of Gloucester. I'll talk a little bit more about seafood as we go along, because we've got some good things coming from that perspective. But it's important for us to make sure that we understand what's important from the local community. Fresh meal solutions, I mentioned. Customers are really more savvy than ever, right? People are watching TV shows about cooking. People are reading magazines. It's a fun thing to do. And all these things that I mentioned earlier about what's hot in the industry really are directly related back to that. With respect to innovation, e-commerce, I've mentioned a couple of times earlier today. Stop and Shop actually, and Ahold, Royal Ahold, owns Peapod, which is one of the biggest sales producers for online and in-home delivery in the United States. We services over 400,000 people on a weekly basis. It's got a $158 average order size, which is about 3 to 4 times the average order size of a normal order in the supermarket. So it's a very healthy business. But if we think about it, it's really, from an online perspective, it's only about 1% of the food retail being done now. So there's tremendous upside as we look at Peapod and what we can do for folks. Also, from a technology standpoint, it's important for us to keep investing. Right now, we invested in Scan It, so folks can shop themselves and check themselves out. Self-checkout lanes, which are important for speed and accuracy. And it's something that folks, some folks prefer doing. I want to mention that I'm sure folks heard in the news that actually Royal Ahold is in talks with Delhaize for a potential merger. And we talked a little about, Fred talked a little bit about consolidation in specific industries. Certainly, this is one that has a lot of consolidation. So Delhaize, who folks who don't know, actually runs the Hanover brand, which is in our marketplace here. Also, Food Lion down south. Hannaford has a big presence in the northern states, New Hampshire, Maine, Vermont, and all the way to eastern New York, the Capital District. And Food Lion obviously goes down to the coast of the Carolinas. On 3/18, there will be shareholders meetings to vote whether or not to proceed with this merger. And from there, obviously, we'll do all the due diligence. But when it's done, if it's done, we will be the largest grocery retailer on the East Coast and the 3rd largest grocery retailer in the country. I want to talk a little bit about what's important to Stop and Shop New England and what we do from a local perspective. Stop and Shop is a proud supporter and partner of the Worcester County Food Bank. In 2015, we donated over $1.2 million to the food and cash to help fight hunger in Worcester and surrounding communities. We're committed to promoting healthy living and the importance of good nutrition, exercise, and well-being. We have nutritionists on staff. We take our role in the community very seriously. A lot of interesting things going on in the industry. A lot of interesting things going on from a competitive set. Talked a little bit earlier about what's going on with competition, but In New England, we had over 1 million square feet of selling retail that opened up against us only in the last year. So if you put that in perspective, there was over 30 new stores, supermarkets that opened up against us. And they range from new Wegmans in the marketplace to Market Basket, which is a strong regional player, to exposure of Walmart and others. And on the value end, Aldi's and Price Right, which also did very well and came on in a big way during the last recession, slowing down somewhat, but still important to a lot of consumers. When we look at that competitive set and the understanding that we continue to grow as a company, very proud of those efforts, and I think it's an important part to understand what our investment is, because the reason why we continue to grow was because we invested significantly back into our value proposition. We've taken all the efficiencies that we can, and every dollar goes back to lowering prices and making us a better offer for the customer. We understood that was an opportunity. Customers told that loudly and clearly. We understood it, and we moved in that direction. We'll continue to move in that direction. So, as we sit here today, I'm still a little scared, Fred, but I'm proud to be here, and Worcester to me is a great place. We obviously continue to do business here, and it's an important part of our business. So thank you for having me.
David Seigel, thank you very much. Thank you for being so gracious about the name thing, too. I had Peter on the brain. Can I just say $1.2 million worth of support for the Worcester Food Bank? Round of applause. That is incredibly important and valuable. Our fourth speaker, Joseph DeManche, is Executive Vice President of Ameresco, and if Worcester is the solution to everything, Ameresco has been for a lot of businesses the solution to one of the major challenges you've heard people talk about up here, the cost of energy, which is such a huge issue in central New England, so much of the state, along with housing and health insurance. And so to take a deeper dive on where things are in the world of energy, what we can expect coming up in 2016 and beyond, how you can potentially save on that giant electric bill and heating bill, Joseph DeManche.
Thank you, Peter. As Peter said, my focus in speaking to you today will be on just one element of our economy, the energy services sector. And it's one element, but it's a ubiquitous part of our economy. It's embedded in our household, government, and business budgets, and its cost, price volatility, reliability, and resiliency affect our local cost of living and the competitiveness of our industry. It's supplied to us through a capital-intensive, nationwide network of pipes, wires, generating equipment that we all pay for in our energy bills. And decisions to change or expand that network involve actions that we pay the cost for over 20 or more year periods. It's a sector that's in the midst, early stages actually, of a major evolutionary change. And this evolution appears to be similar to those we've seen in other network-based sectors like computing, information, and telecommunications services. And the features of that evolution include smart devices moving to the edges of the network that delivers us the energy, resources becoming less centralized and more distributed around the network, and continuous reductions in cost driving the rapid adoption of new technologies. And those can be as simple as LED lighting in your facility, to highly efficient distributed generation equipment, to wireless sensor networks that can control your building more efficiently. Massachusetts has become an important locus for this new business, for the new businesses that are driving this change, this evolutionary change. An ecosystem of new energy services expertise has developed here that is perhaps stronger than in any part of the country, other part of the country at this point in time. I hate to be the third person to mention this, but GE cited this ecosystem as a major factor in their recent decision to locate their headquarters in Massachusetts, and they've created a new division, GE Current, that's going to focus specifically on this opportunity. So what does this new ecosystem look like? The best way that I can tell you that is to tell you a little bit about the company that I represent, Ameresco, which is a participant in this energy services ecosystem. We're headquartered in Framingham. We have customers across North America and the UK. For an idea of scale, we employ just over 1,000 people and had revenues of just under $600 million in 2014. It's a new ecosystem of businesses. We were founded in 2000, became a public company in 2010, and over the years have constructed $5 billion worth of energy efficiency and generation projects, including over 300 megawatts of renewable and conventional energy assets, most of those in the United States. What do these companies do? Well, our services span the range of energy cost reduction opportunities for our customers who are all at the edge of that energy generation and delivery network that I talked about. We deploy new energy efficiency technologies in our customers' facilities to reduce the amount of energy used and the cost of operations. We build renewable and conventional distributed energy generation facilities, electricity predominantly, to reduce customers' dependence on the network for supply, and in some cases to allow the customer to sell excess supply back to the network. We assist our customers in buying energy at the most competitive price from the network. There are elements of that network that are competitive in terms of supply, and knowing how to buy from that network can reduce costs. We provide hardware and software intelligence within customers' facilities to control the energy use continuously for lowest cost. And finally, we arrange financing to fund all of these energy cost reduction strategies. As I commented earlier, energy is ubiquitous in our economy, so our customers span a wide range of markets. One common thread is that our customers all have a multi-year commitment to the current location of their operations so that they can reap the full long-term benefits of any capital invested in reducing their energy cost burden. It's an example of the type of projects that we're talking about that we perform. Is our work over the last year with the Massachusetts Department of Transportation. The DOT made available to us a number of parcels of unused land along highway rights-of-way that they own. On these parcels, we installed 5 megawatts of solar distributed electric generation that we own, maintain, and operate. We lease the land from DOT for these. We sell the power generated by these installations to the DOT. They use that power in their facilities throughout the state, offsetting purchased power from the network. The benefits to them are a reduction in their electric costs over the life of this project of about $15 million. So what's the value to the region of hosting this new energy services ecosystem here in Massachusetts? Because we're relatively natural resources poor here, when we buy more energy these days, we're mostly creating new investment and new jobs in places like Texas, Pennsylvania, and with recent proposals in Quebec. When we meet the needs locally with energy efficiency and distributed generation technologies on our own part of the energy network, we reduce our own cost of energy, we make capital investments, and we create jobs for local engineering, constructions, and operations workforce here in Massachusetts. So that's, I appreciate the opportunity to talk about this new business system, this new ecosystem here in Massachusetts, and thank you.
Excellent, thank you. And before I go to your excellent questions, one just straight out of the headlines thing I'd love to ask you about, Joseph. People may have seen in the headlines this week, Massachusetts hitting the cap on the number of solar renewable energy credits, in a sense that there may be a bit of a chill on the solar market in 2016. I just wonder if you can provide a more lucid explanation than I have of what's just happened and what it potentially means for people. Yeah, solar is supported by a number of
legislative actions that allow it to interface. Solar is mostly performed by private companies that have to interface with a monopoly-operated electric grid in order to get their power delivered. So there are a number of legislative actions that allow that interface to occur. One is called net metering, which allows you to take the power that you generate in a distributed generation facility like that, put it up on the grid, and deliver it to a different location. The DOT project that I showed you does that. We generate along the side of the highway, literally. That power is fed into the network, and it's pulled out at DOT facilities across the state for their use. So that opportunity needs to be there. In addition, solar qualifies. In the state, we have had, and many other states have this, what's called a Renewable Energy Portfolio Standard, which requires that the utilities in the state obtain a certain percentage of what they sell from renewable resources. And the way that's done is through this solar renewable energy certificate program. So when you generate, you get a certificate, the utility buys that certificate from you and delivers the required percentage of certificates at the end of the year to show their, to show that they've met that percentage requirement. The cap on issuance of those certificates has been reached. So that would need to be extended as well.
I'm going to say, bottom line, probably a lot of pressure on our state legislature to make a decision about what the state's solar policy is going forward.
There is, and as you all might be aware, in the state currently we're in a fairly precarious position. We have, over the next several years, about 4,000 megawatts, which is 15% of generating capacity in the New England generating region that is heading for retirement. We need to replace that capacity. Otherwise, we may have reliability problems. We certainly would have cost of electricity problems. Solar is one way to help. The solution is sort of like what they talk about for the climate change, a little bit of everything. And solar, increasing those legislative programs to allow more solar would be one way to help fill that gap that we're facing in the state right now.
Excellent, great, thank you. Well, let me go to your terrific questions that have come in on the index cards, and we want to go back to Karin, go back up to 35,000 feet, and we heard your thoughts about what the Fed has done, what you think the Fed ought to have done, which I candidly would say I agree with you. I wish we'd gotten off zero a lot sooner and gotten back to something a little more like a normal fiscal and monetary policy. What's your expectation about what the Fed will do in 2016 in terms of when and how many rate increases?
Sure. So fair enough. So we think the Fed is probably going to pause in March. The next Fed meeting is in March. Yesterday, and actually today, if you're watching your phones, Janet Yellen is currently speaking before the Senate. And we think she's going to pause in March. I think there's been a lot of turmoil in the financial markets, and one thing the Fed does look at is something called financial conditions. So to cut a long story short, when they see markets looking uncertain and they see markets falling, they see the dollar bouncing around, they do take that into account on the margin. So we think they're likely to pause in March. We think the first hike for this year, but the next hike following the one we had in December, will come in June. That is actually now a consensus view. When we first had that view, we were a little bit maverick, but now it's largely a consensus view on the street that the first hike is probably, for 2016, is coming in June, to be followed by one or two more, depending on the data. The Fed will happily tell you they're data dependent, and I think they are. I think they go into the meetings ready to discuss and evaluate and make the decision on the spot. People may come in with biases and preferences, but I think they're willing to, hold off the decision until they've had that discussion and their two-day meeting. So likely one in June, maybe another two. That said, the market is pricing in none. So there's got to be some meeting between the markets and the Fed view about what the true number of hikes this year will be. So that'll cause some volatility in and of itself, just as the two kind of have to come to some agreement over the time.
Fact-based decision-making is a wonderful thing. And a second part of that, you alluded to obviously what's going on with the yuan. And the question is your predictions for the US dollar, its value, and how much should we be focusing on that in 2016 for small, medium, large, local, multinational companies?
Right. So the dollar's been interesting. We obviously had an extraordinarily large move in the past year and a half, something like 20% appreciation of the dollar, really marked a turning point in what had been a long trend of, say, either stable to weaker dollar, and then suddenly got a lot stronger. That's painful for us, obviously, because it cuts into our ability to be competitive when we export. It also is painful for us as an economy because it keeps inflation low. Usually that's a good thing, but when inflation is too low, it's problematic. So we think from here, the dollar is likely to strengthen further. We're in a situation now where it feels like central banks are in a zero-sum game where everybody is trying to be more accommodative than they were before. I'm really thinking about Europe, China, Japan, more accommodative than they were before, and also perhaps relatively more accommodative than their neighbor. That makes it a little zero-sum. So Japan took a very large step in trying to weaken their currency by choosing to have negative rates. It had something like a 2-day effect and then was undone. Europe is continuing making comments to promise more easing coming at their March meeting. The Fed is indicating they might pause, but even if the Fed does nothing, as long as Europe and Japan continue to become more accommodative either through further negative rates or buying more assets, that's going to make us look tighter, and it's going to make, in terms of policy, and therefore it's going to make our dollar a little stronger. So what we expect for 2016 and beyond is a slightly stronger dollar, not nearly the kind of momentum and pace that we saw in the dollar in the past 2 years, but a little bit of a stronger dollar, just because we're at the point where I would argue we'd like to get back to a normal rate environment. That means slightly higher rates, where everyone else in the rest of the world, particularly advanced economies, is still trying to really get their economies off the ground. So that's going to support the dollar for better or for worse, and will hurt our export orientation. And I did have a look actually at the regional New England's exports and Massachusetts exports, and of course it's no surprise that exports to any place like China have radically declined because China's in a downturn. However, exports to Mexico fairly robust. So it sort of depends on the currency. Currency drives a lot of that export equation. I'll just close with the observation that once again our economy has transitioned over the last 30 years or so, and exports are important to our growth, but they're not as essential as they were in the past. They're still important, but it doesn't hurt us as much when exports turn down as it has in the past.
Interesting. We heard Karin predict likely $50 barrel oil by the end of this year. We had a few different questions that are basically all energy related, and I thought I would ask the rest of the panel your thoughts about how businesses can sort of best play this current cost of energy environment. I mean, I loved seeing $1.70 gasoline on Route 9 in Shrewsbury last night, for example. But it feels like maybe it's a window that doesn't stay open for as long as we would hope. If you're advising people, how do you take advantage of this current positive trend? Supermarkets that pay a lot for refrigeration and freezing. What are thoughts there around making the most of what we're being dealt with by way of a hand energy-wise?
First, I'll address the $1.70 gas. So since I'm a retailer who actually owns gas stations, we're obviously experiencing a lot of deflation in gasoline. So when we look at our sales with gas, it's obviously having an impact. Having said that, from an energy standpoint, obviously, we've seen some positives versus where we're budgeted from an energy standpoint after coming through a year where electricity really hurt us badly. Electricity costs were high for us, and it affected our business, and we had to mitigate our way through that. So when we look at energy in total, we're obviously seeing some savings that we can invest back into the customer. I mentioned about what our efforts are moving forward. And that goes for right across the board, looking for efficiencies and make sure that we're as productive as possible. So we're going to invest back.
Maybe a sharper way to put this, Joseph, is sort of how long should people expect this current environment to last with energy prices, and how should that affect your decision making about, say, installing solar or putting money into energy efficiency or some new type of vehicle fleet?
Well, first of all, oil in the United States these days is largely relegated to being a transportation fuel. Not that that's a minor part of our energy economy, but for most of us in business, electricity and natural gas are the much more important energy sources. Natural gas has seen the same price, and it's driven by production in the continental U.S., the same price depression as oil, and they're suffering in Dakota and Texas and in the Marcellus Shale pretty badly right now as marginal producers are having to stop production. So having said that, so much of what we pay in our energy bill these days is related to the network of wires, pipes, and generating equipment that delivers the energy to us, and less in the commodity cost. Those network costs continue to go up. So at the edge of the network where you're buying that, when you look at your total bill, it really doesn't matter to you so much what the different components are. Lower natural gas prices, where natural gas is used to generate your electricity, helps a portion of your bill, the energy portion. It doesn't help the transmission, distribution, other charges portion of your bill. So the market for being energy efficient, the market for generating your own electricity at your site continues to be supported entirely by its investment economics. We find plenty of people who see 2, 3, 4-year paybacks from doing that kind of activity. Energy efficiency nationally continues to be the cheapest form of new energy we can develop. It's a hard one to get at because it's lots of little things all over the place rather than one big mega project like a power line down from Quebec or a new natural gas pipeline through the middle of the state.
And Fred, you talked obviously about seeing production capacity being idled. And I'd love to hear your thoughts about this current energy environment. How long can we bank on it? What should we be thinking about doing or not doing based on price trends?
For me, the way we experience it, we need some stability and some transparency right now, because that's part of the issue. And again, what's fascinating about that business is that the cost curve of production changed a lot in the last couple of years, 5 years, with all these new production sources. And as that price changes, it changes the whole supply-demand balance, right? And we're right in that period where you have a lot of businesses that have built with, long-term debt, but short-term problems because there isn't a margin in the business anymore. So from a business perspective, my view is that this will settle in the next year or so because of the uncertainties and, frankly, some of the world uncertainties, and that'll be helpful. But there will be some problems out of that, right? So from a debt point of view, matter of fact, I think some of the financial services noise is the amount of debt that people are sitting there saying, what is the problem going to be? So if you've seen the marks on all of that debt, it has been very volatile because people are trying to say now, how bad is this going to get? The other thing I would say about the energy industry for all of us as people that are trying to build retirement savings, if you think about where people are trying to go with the yields being so low, and frankly, this is unprecedented how long we've been in this period of low yields, and so many retirees and so many people having no place to put their money. Just think about what the biggest dividend producers in equities are, right? So people have shifted to equity dividend producing equities. What are they? They're the utilities. They're the oil functions, and so they're the commodity players, the mines. So what you're seeing is a tremendous resetting of a lot of the dividend-producing companies in this country. Which again,
it goes back to Karin said, where do you put your money here? I mean, this is a really interesting time for people that are trying to get a little bit of yield and anticipating maybe the comeback of inflation, but it hasn't come, and there's really no place to put your money. So again, I'm not saying talking just energy, but it is a very uncertain. Energy is driving a tremendous amount of uncertainty in the way people are allocating capital right now, and that has to get clarity. Even if it's clarity lower, that's good too, right? It'll wash out of the system and it'll settle. But we need to have that, in my view, relatively, in a short period of time for things to settle in.
Who would have ever thought $30 a barrel oil would not feel so good? We have a question thinking about sort of Worcester County generally, central New England. Karin obviously pointed out manufacturing down to 12% roughly of the U.S. economy, but skilled manufacturing, from my vantage point, such a great strength of this area of the state and region. And the question is, what's the likelihood of reshoring of manufacturing given current energy prices, but the loss of a generation of knowledgeable workers, near term, long term? How bullish could we be about potentially, more skilled manufacturing, even more than already has coming back from China and abroad?
I mean, Karin has the trends, as Karin said. The broad trend is the broad trend. As I mentioned, I'm more bullish than many on this exact point. If you look at the cost structure, and it started in services. If you look at the outsourcing of voice-based service in the financial services, to India and a couple of other English-speaking countries, it's coming back, right? I mean, what's happened is the effectiveness, the efficiency of it, maybe the little bit political unrest in these places. And if you look at the margin or the contribution of the informed worker in more refined manufacturing, and then you take energy and you bring energy costs down, that is the category that you would be more bullish that it would come back. And so I actually, and again, there's micro pockets of it already, but and to your point on Worcester, which is interesting, and I think most of the people here know this, that was really our heritage, right? It wasn't just general manufacturing. It was some of the most insightful kind of really cutting edge manufacturing in so many categories. And because of the worker, the education, again, I come back to kind of the informed knowledge based workforce. So again, the question is, is it going to ever go back to a to the percentages we saw no, but could it stabilize and come back a little bit in some pockets? I absolutely believe that's true. And as the economies of these other places where you're outsourcing to beef up themselves, right, and they go to a consumer based and their salaries go up, right, at some point that trade-off comes back, right? I mean, and so again, it's not completely clear to me that that's not going to happen in a number of categories, and that we couldn't, in the right areas, take advantage of it in the right industries.
Karin, I'd love to hear your thoughts about that.
I agree completely. I think there are instances where reshoring is making sense. There are places where, as you mentioned, the consumer is more discerning. They want a consistent execution of service, and they want a quality product. And oftentimes, companies feel like they're more able to ensure that if it's onshore and closer to home. So kind of combined with a lot of, say, political uncertainties, maybe economic uncertainty, and a drive to have the best in class in terms of service provision, certain types of jobs are kind of reshoring back. I agree with you. I don't think it's like a long-term structural trend, but it's a possibility that we've kind of overshot or undershot a stable point, and we could come back a little bit with that. I think that, as we see the emerging markets finally morph into more consumer-based economies, as you mentioned, that definitely will cause a rebalancing globally. That, for me, is sort of a 10-year story, not a 2-year story, but I think that's almost a sweet spot. That's when you might expect to see a lot more upward price pressures because you have a lot more consumers chasing goods, chasing experiences and technology. So I don't see us in a permanently low deflation, sad sack kind of story where manufacturing's on the floor and consumers are barely holding in. I think we really will all find a global rebalancing. We're just in a transition point right now where slowing down and trying to transition. We're trying to come out of an unusual environment, and Europe is still trying to fight its way out of a deflationary scare. So I think it's the transition point we're in 2016 that's going to make for a bumpy ride, but I do feel actually optimistic, just as you do.
Good. Hey, it's all better. See, it's all better now.
I feel much better.
I think that's a very interesting point that Fred makes about, for lack of a better term, call center work. You know, that Bobby in Manila, who you're talking to at 2 a.m. Manila time, may not, the amount less you're paying Bobby to take the call doesn't deliver the kind of service that somebody right in the state would. I wonder if there's any more you can add to that, sort of experiences you've had or seen around that type of customer-facing work.
Totally. I mean, again, go back to what's happening with service in general and the need for more immediacy, more insightful response, maintenance of your computers, or, you know, I mean, there's a ton of remote servicing functions that I would argue that people have found inconsistent ability. And Manila's a great example. Manila was the place there for a while. Ireland was the place for a while. And again, in financial services, many of us have found that that's not exactly the nirvana. And even in technology outsourcing, what you're seeing is more of a balance of onshore, offshore, and yet maybe you'd want to cover 24 hours, but it's not the rush that you talked about, in the past. And again, I just think that's because of the quality of service. I think your ability to be efficient with service, with technology assistance. So it's not just hours. It's the quality of that interaction. Healthcare is a big one. If you look at the size and growth of healthcare and remote service in healthcare, that's coming on. I mean, most of that is onshore support. Even some of the back office things in healthcare that went overseas, like documentations of record stuff, that you're seeing moving too. So again, I look at that, and again, our world is weird because we see it because of the growth of these businesses and these exposures, but it's true for us too, I think, which brings you back to, we could talk about education, we could talk about a lot of things that are required for our country to really take advantage of that. And to be more stable in the growth of the economy. I've seen it, again, you see it time and time and time again. The other thing we do, which is a little unique, is we are a big insurer of political risk and terrorism. So we have insight into these companies that have these employees off, like we insure that. And you can see the risk profile, as you can imagine, in today's world, has changed in a lot of these places. And that really affects companies and how they think about it. And again, I think that's part of it too, right? Just the safety and the whole thing that's occurring in some of these places that were centers for this. It hasn't taken off in some areas as much as you would have expected because of that. So.
Can I add to that? You mentioned something that, I wouldn't be a true economist if I couldn't say on the one hand, on the other hand. And so and also because I'm optimistic, I like to say there is also another trend that I think is maybe countering the opportunity for skilled labor, which is robotics. I'd love to hear if anybody has actually a real world anecdote around robotics or replacing labor with those kinds of capital investments, because economists obviously are just people who see things in practice and then look for a theory behind it. You guys actually see it in practice. But what I'm understanding is that robotics is increasingly replacing in manufacturing people because maybe it's cheap, it's reliable. I read an article about a company in Germany that's actually all robots. I think there's one guy that turns the lights on and off, make sure they're all plugged in, but it's all robots that are doing the manufacturing. So I do think that that's a counter trend to the opportunities for high, what we'll call like a working class wage support that we saw in manufacturing 20 years ago, and then that morphed into construction, which is one of the great charts that was put up today, how construction jobs are starting to come back, and we'd like to see them come back more. Construction was something that sort of offered a good working wage after the manufacturing wages went away, and the question is, what's the next industry that will offer a good working wage? Is it still construction, or is it going to be something else? And in the meantime, how much is robotics eating into those opportunities? So I don't know if anyone else has I didn't mean to hijack the panel, but if anyone has any observations, I'd love to hear them.
So we'll all have to oil the robots. That's the new job.
That's the only job.
Well, this is a little bit anecdotal, but products we buy tend to go through, if you will, a manufacturing life cycle. So when we have a new technology that we're introduced to that we can deploy on behalf of our customers, it tends to have been innovated here and initially manufactured here. Demand grows for it, and it starts to migrate offshore. In the case of solar panels, that offshore migration for a short while migrated back onshore through robotic production. The Chinese manufacturers now have adopted robotic production, and it's migrated back offshore. So we see with a lot of the technology we deploy sort of the Apple iPhone effect, where it says on the back, designed by engineers in California, manufactured in China. We seem to be the source for the innovation and the initial, and call it innovative manufacturing, figuring out how to manufacture, and then, as you say, a lower cost labor environment tends to take those lessons and deploy them at scale. Interesting thing with solar panels now is, and this was a big win for Buffalo, I don't know if you all heard it, but one of the larger companies that deploys solar panels, Solar City, based out of California, is now building and I think the New York State kicked in $1 billion for this, building a high efficiency panel manufacturing facility in Buffalo. And it's a case where it's a new, highly efficient solar panel technology that has to be produced robotically to keep the quality control. And so they've elected to locate that manufacturing here. So there is hope.
That's interesting. I know nobody will complain if we get you 10 more minutes of networking and 10 fewer minutes of sitting in your chairs. But I just want to make sure we get to a couple more questions. David, when you mentioned that number, 1 million new square feet, 30 stores coming in to compete with you, I'm sure everybody who's in a competitive business, chills went down their spine thinking about numbers like that. And I think of Stop & Shop as a great chain that can appeal to the whole spectrum of grocery buyers. And the question was, can you say more about how you think about competing against, in that environment, Walmart down here, Target down here, Wegmans up here? How does that play into your strategy, your marketing strategy?
So we feel good about it. Based on the information I shared, we continue to grow across the East Coast. I think when we look at these competitors, who are all good competitors, you look at regional businesses like a Market Basket. That was a story that was told nationally last year, as the employees walked out in order to support the CEO. That came back again, to Walmarts that are actually struggling a little bit right now. From an ID perspective, they're closing some of their Sam's Clubs, and it's an opportunity for us to grow versus them. To Wegmans, which is a very good retailer, a very interesting retailer. But I think, to your point, we appeal to the majority of customers in our demographic base. When we look at the market share that I talked about, in over 36%, and we're the #1 retailer in almost every market we do business in, I think it's because we have a fair value, we offer good service, we have very good assortment, and to the point of the anti-point, I guess, about the robots is that our people are what make us great, right? So when we think about our associates and those 36,000 associates in New England, and the importance of them to what represents us as a brand, I think that's critical. So when I think about all the good things we have going on, including that continued investment that I spoke about, it's the people that make us different. And we'll continue to invest in those people to make sure that we'll continue to grow and be sustainable. Can I say one more thing, Peter?
Absolutely.
We were talking before about energy, and what I failed to mention before when I was speaking was one of the things we're really proud about is that in Freetown, where we have one of our DCs. We have a
Distribution center.
Distribution center, sorry. We have an anaerobic digester that's going to go online in a couple of months, which is going to power 1/3 of that building, which is almost 1 million square feet. So it's going to use all the excess waste that we can't give to, that it's no longer good food, and other materials. Obviously, I mentioned food banks before. We're also a big supporter of the regional Boston Food Bank. But when it's not usable anymore, it'll go into that, and I think it's a pretty tremendous thing. It's one of a couple that's actually in the nation. So,
excellent. Before I turn it back over to Peter Stanton, I just would love to offer you, if there's any other observations, thoughts, reactions, anything else you're dying to say and share with the crowd.
Don't depress me.
It's all good. It's all good.
I agree. It's all good. You'll be all right.
Excellent. All right, I feel better. Let me turn it back over to our co-host this morning, Peter Stanton.
Thank you, Peter. I must have not just looked at my cell phone and seen the market down by 285, did I? No, sorry. I think after this, at the conclusion of this, once sort of the press gets out on this conference, the market will be bumping back to the north. So I want to say a special thank you, to our sponsors, to our co-partner at the Regional Chamber of Commerce, Tim and your team, to Bank of America, to the Robert Foisie School of Business at WPI, our community sponsors, WBDC, Kelleher and Sadowski, the Mercantile Center, our corporate sponsors, Bolus Lynch and Spectrum Business, as well as Millbury Credit Union TV3, the Beechwood Curry Printing Elevation Exhibits, Mark Serra Productions, Revelation Productions, and Ron Blais, our photographer. All of them helped make this special. Thank you very much. And as a pickup on Fred's theme of The Answer is Worcester, we have these lovely Heart of the Commonwealth photo books that highlight the city and the beauty of the region and sort of say to anyone receiving them, what a great place to be doing business this is. So we have one of these for Peter Howe and one for each of our speakers. So business will be booming in our region. Thank you all very much for coming. Enjoy the rest of the day.